Hi, I'm Keith McCullough, and welcome back to another Real Conversation, where it's my pleasure and privilege to welcome back Mr. Daniel Alpert, who's the managing partner of Westwood Capital. He's also the author of one of my favorite books, The Age of Oversupply. So we're going to talk about that, a lot of different things. He can cover pretty much the waterfront. Welcome back, Dan. Thanks for taking the time.
Good to talk to you again.
We can kind of go anywhere here, but I think that maybe just grounding people with your overall longer-term view on the age of oversupply. We've obviously seen deflation play out in many different regards. However you want to address that would be great. But also, the year-over-year math that is inflation accelerating. We're at a point now where we're just lapping against the mother of all deflations, of course. So I was curious on what you thought about that rate of change data series.
Well, I think the rate of change is obviously enormously affected by energy prices, which, a couple of years ago came tumbling down and reset everything. And so sometimes coming back off a very low base can be very confusing. But the fact is that the driver of U.S. inflation or deflation or disinflation is still fundamentally global interaction between the U.S. economy and the economies principally of Europe, Japan, and China. And when you look at those situations, you have very, very interesting dynamics, because the chief way that we import deflation, to use a term, is through both price and currency action on the part of our trading partners. And this is an ongoing phenomenon. The energy price issue has its own side story to it. Obviously, you have supply and demand issues in oil. Oil is also often used and has been used, especially right after the Great Recession, as a dollar alternative, meaning that people would invest in oil futures as opposed to expose themselves to a dollar that at the time people thought would be weakening. Of course, the dollar didn't weaken at all; it strengthened massively. So you have a lot going on with oil that kind of clouds the view, and so you have to really look at inflation in the United States, ex oil and ex energy and ex food. And what you see is pretty simple. U.S. inflation, to the extent that it's positive, is driven only by the service economy, and for the most part is being driven by rents. Now, you've had a buildup in inflation in a couple of other service sectors during the course of the last roughly 6-7 months. And so people are looking at that and saying, well, that is mitigating in favor of continually building inflation. But really, that is not playing itself out, other than with exceptions of 1 or 2 month statistics. It's not really playing itself out on the good side. And the good side, in my opinion, continues to drive the disinflation story in the United States economy. The reason for that is obviously your manufacturing workers are the higher paid level of workers in your economy. The only ones who are similarly paid are people who are in the professions and people who are in the sales side of manufacturing. And being in the sales side of manufacturing or being in the sales side of distribution of things, obviously when things cost less can be paid to sell them. So those things are very, very much connected. So what you have now is 3 sources of manufacturing of things, and obviously when I speak to Europe, I'm speaking mostly of Germany, which is running a massive trade surplus against the rest of the world. You have Japan, which has always been there. The difference there, of course, is that for many years, people in the United States were pointing their finger at the Chinese, in some cases appropriately so, for having manipulated their currency down in order to gain trade advantages. Right now, however, many economists, including myself, believe that the RMB is actually overvalued. And if left to their own devices, the Chinese would see the RMB fall. And what they're really trying to do is maintain stability in the RMB in order to be able to move forward and make the RMB into a global currency. They already have 1.4 billion people using it. right? They want to be able to find greater uses, the ability to pay for goods and services in their domestic currency, gain some percentage of that exorbitant privilege of having a reserve currency, and that's not going to. It doesn't help them if the yen tanks. So they've been stabilizing it in the upward direction, and unfortunately, that doesn't say very much about the ability of the U.S. to forestall another wave of deflation should the currency weaken.
Mm-hmm. If you look at this, I mean, relative to Trump's narrative, Navarro, the Chinese situation is very unique in that, again, to your point, the Chinese are now tightening or attempting to maintain some kind of a strength in the currency. Do you think there's a breaking point given the closed capital account and whatnot? We would argue there's not that kind of big foreign currency breaking point with foreign flows going the wrong way on them in a hurry. Do you agree with that or not? Do you think there is a breaking point here where you get through 7 on the RMB and just a blast towards 8?
Yeah, I mean, there's two things about this. One of the things about just looking at flows for a second, the sort of, I don't know, layman's view of this was that you had a lot of flight capital, a lot of Chinese capital seeking to leave, convert into dollars and leave China and invest elsewhere. And yes, right. That was a huge, huge phenomenon, and it's particularly tactile to people in the West when I'm an investment banker, when we see enormous flows of Chinese capital investing in our clients, right, in our companies. And so you sit back and you say, aha, I see. This is why Chinese foreign reserve balance has declined so much, because there are all these people running around, individuals buying apartments in Manhattan and London, and companies, bang, bang, the Waldorf Astoria, and that's where all the money is leaving. The truth is the reduction in dollar reserves and to a certain extent euro reserves in China is not really all driven by foreign direct investment in outside of China. It's really driven by a huge effort on the part of the Chinese to lessen their dependence on foreign currency, hard currency denominated debt. Mm-hmm. And they have been paying and rotating out of foreign currency denominated debt like nobody's business. Now, they pretty much are done with it, and it ended last year. So a lot of that huge downtick that people have seen in their foreign currency reserve position is unlikely to be repeated in 2017, even if they open the tap a little bit and allow, because as you know, they've been tightening in terms of allowing FDI, foreign direct investment. So I believe actually the pressure is off them on the FDI. I think you'll see a little bit more FDI in 2017 than is currently the case. Obviously, it's very tight today. And the reason for that is they're not going to see the same downtick in their foreign reserve balances by virtue of their loan payoffs. So this is a very interesting time to watch China. The bottom line thing that drives the Chinese economy and Chinese politics is employment. Mm-hmm. They have 1.4 almost billion people. About 650 million of them are employed in the actual global economy-related businesses that they have. Another 600 million or so are down on the farm. And they are adding to that roster of people who are competing in the global economy in one way or another, directly or indirectly, or servicing those who are, at the rate of about 10 million people a year. And they have to continue to do that. That's very important for their domestic social harmony. If they stop, a good way of thinking of it is if you have 600 million people, they have roughly 10 million people a year turning 18 in that cadre. And so as a practical matter, what you're promising the people down on the farm is that you're going to give their kids a job, right? And if you stop doing that and you actually create a situation where you can no longer increase employment by this tremendously underemployed populace, you're going to have social disruption. And if you do it in a way that results in employment and then downticks in wages because you've overemployed in the export sector, for example, you're going to have a problem as well. This is something that has been going on for a very long time. China and let's just not forget it's not just China. There are a lot of other low-wage countries. They're not at risk of running out of labor anytime soon. Aggregate demand across the world is nowhere near sufficient to employ everyone. And so we have this problem. The problem has generated enormous surpluses in the part of many of our trading partners, and it's also generated. You saw the employment numbers last week. All of the expectations for wage growth were basically just wiped out with 1 month statistics, and that's why. I mean, I've always said, and I've said this for almost 10 years now, if you move the average hourly wage of the median worker in the U.S. up by $1, you create a job in China, right? Because that is that is enough to reposition manufacturers to China.
I mean, the threat under Hillary was even higher in that regard because we had the prospect of the Byrne finding his minimum wage nationally rising. You could have actually had a little bit of a shock there.
Well, that brings me to the subject of pushing wages up rather than pulling them up.
Yep.
You cannot successfully, in my view, push wages up from below. Eventually, people will mechanize, they will automate, they will find ways of taking out lower cost labor to the extent that they can. But you can pull it up from above by increasing overall demand, aggregate demand for labor. And that is the ultimate form of trickle-down. Trickle-down capitalism doesn't work. Making people rich and expecting that they're going to simply expand their businesses because they have money in their pockets when there's a place that they can expand them more profitably makes no sense whatsoever. But trickle-down labor demand actually works very well. If you increase the demand for labor at the top, meaning the more skilled workers, and you suck them out of the economy, giving them more, take the old saw today, which is take the former construction worker who's become a bartender and give him a hammer back, right? You will now need a new guy to tend bar.
Yeah, that's a great point.
And so the upshot is that what we need to do today, and where Trump is absolutely right on, and by no means am I a Donald Trump supporter.
Really, I couldn't tell on your Twitter handle.
But where he is, I guess that's a fair point. Where he's absolutely right, and whether or not this meets with his Republican majority in Congress. Where he's absolutely right is the need for an aggressive infrastructure program in the U.S. And the best way to explain that is to simply say, look, if you have a glut of cheap capital, and we do, and that's why, notwithstanding all of the nonsense and the massive sell-off and the massive quote-unquote, I'm putting that in scare quotes, sell-off in the bond market, we are still not back on the 10-year to a yield equivalent to where we were during the taper tantrum.
Not even close. Huh?
Right. And arguably we have a healthier economy than we did during the taper tantrum. So you would think rates would be higher. So we are looking at a bond market that once again is signaling something different than the equity market, as it always has since the Great Recession, with the exception of the taper tantrum. This sell-off in bonds will not continue unless there is meaningful movement in economic activity, and I don't see that coming down the line, especially in the second quarter, because of what I saw at the end of last year in terms of inventories. I don't see we're going to see another cycle of that, and I think we're going to see a little bit of a scale back, as we always do at the beginning of each year after the Christmas season in retail sales, and that's going to send some jolts into the market. But getting back to the issue of where Trump is right. If you have a massive glut, especially an external glut of capital, and that capital is not flowing back, into the U.S. economy in terms of investment in productive plants and equipment, what you really ought to do with it is you ought to take the agency of our society that can borrow it cheaply, and that is the government, and have the government take that action that pulls up wages. By reemploying large number of steel workers and construction workers and all the support industries that support those manufacturers of every kind, to rebuild our domestic infrastructure. That is the shot in the arm that this economy, and quite frankly economies throughout the developed world, require. Pity Japan, because their domestic infrastructure needs are not as great as Europe's and the United States. There's not much more that they can do. They have a very rapidly aging. The only thing I've suggested to the Japanese is build nursing homes. I mean, because that's pretty much all they can do. Yeah.
Well, it's interesting, the point on labor, and I think everyone, when they really think through what you just said, I mean, there's a difference between pulling wages down as opposed to centrally planning or mandating them up. I mean, that is definitively some version of socialism. But if you take, so the labor discussion is one. The other one that you flip to, and again, masterfully so, is the capital discussion. And that capital discussion, when it comes to Dodd-Frank, is one that, on the table now, you have an opinion on this. Everyone seems to have an opinion on this, I'm sure. They want to de-emphasize capital constraints, and on the other hand, just focus on maybe not having a bunch of people lie to you or have hidden leverage, I guess. Where do you fall out on that Dodd-Frank debate on the capital point?
Yeah, so it's interesting. So to me, ironic in a certain respect that the folks in the financial services industry who want there to be greater liberalization. By the way, I fully endorse the notion that Dodd-Frank, in terms of its effect on local banks and to some extent regional banks, has created enormously onerous regulatory requirements that there needs to be some relief of. It was a little bit of the pendulum going too far.
Well, because you have an unequal weighting. You have the same rules applying to people with smaller capital bases and resources, right? Right,
exactly. Okay. So I think that there can be really creative things done in that area to lessen that pain, and then they should be done. As far as the banking system as a whole is concerned, the strategically important financial institutions have not become smaller since the crisis. They've become infinitely larger. And so consequently, by derivation, they are of greater risk to the system. And so the answer is, if you're going to have these massively concentrating, strategically important financial institutions, these rules and regulations are critical. And you can address some of it with capital, and I think we need to go even further in that direction. But at the end of the day, unless you address some of the practice issues and limit what this fundamentally comes down to the same thing that the Tea Party started with from the very beginning. And since there's a huge correlation between the Tea Party and the election of Donald Trump and the Republicans' Congress, I'll say the following. If you don't limit the activities of the large financial institutions, what you're doing is putting the American taxpayer at risk. Mm-hmm. And you're doing that because these large banks enjoy the benefit of access to, number one, the Federal Reserve discount window, which is a huge privilege. And then secondly, and probably more importantly, they are able to issue deposits that are guaranteed by the federal government. Exactly. And that those are two privileges, to say nothing of their national charters, that put the taxpayer at risk if they behave improperly. And we saw, here was this bank that I had enormous antipathy towards, because I'd been looking at their financial statements for years, that everyone else in the world seemed to hold in such high esteem, named Wells Fargo, that turned out was an incestuous can of worms, and a horrible place apparently to do business in. So. These were people who were running around when they had the worst loan book in the real estate industry, both residential and commercial, during the crisis. They had far fewer provisions for losses on their balance sheet than the other large banks, and I scratched my head at the time and said, how can that be if their quality of their loan book? And then they would say, well, the quality of the loan book is better. Well, why is the quality of our loan book better? Because we haven't taken that many losses.
Because we said so.
Because we said so. So the upshot is it all comes back home to roost, right? Yeah. And I think that we cannot lessen or reduce the protections of Dodd-Frank in a meaningful way on these larger institutions.
If there is a point where Trump looks really, really right. I think we could sit here and talk about where he could be wrong. I think that's what a lot of people spend their entire day and profession doing, for that matter. But if there's a point that you look forward to, or you can't see, for that matter, is there a point where he could look really, really right?
Oh yeah, if he is successful in imposing a infrastructure program in this country, I think he will. I think we talk about $1 trillion program, but those are generally 5-year programs.
Right.
So you spend $200 billion, which is 1/5 of $1 trillion, right?
Yeah.
You spend $200 billion in this economy and additional government infrastructure spending, rebuild bridges and airports and railways and what have you, especially if it's well targeted. Mm-hmm. This economy is going to go crazy. It's going to do great. If you fail to do that, and if you depend on what we would, this is not a Trumpian issue. This is also an issue for Obama as well. If you sit back and just expect that cyclical factors are going to create that condition that you just described, I think you're making a mistake. And the reason is that you have to consider the needs and the exigencies of the other competitors in the global market. Mm-hmm. They are not going to stand by if we have any form of inflation, either price or wage, and not try to capture that demand for themselves. They will, and they will successfully do it. You may remember the Chinese obviously have some room to go if they can easily they can easily allow the RMB to float up towards 8. Yep. It doesn't take a lot of effort. But they also have excess capacity, massive excess domestic capacity. You would hope they would absorb that with internal consumption, but until they get their political and social house in order, that's going to take some time. It'll happen, but not anytime soon. But they've been playing the price game. Look at steel. Look at all these other areas in which they overproduce. They're, for all intents and purposes, they're dumping in many markets. So, they have two levers to play there, and they're just going to do it. What's important to them is not profit; it's employment. And until people get there, there are folks who analyze the economy, and both on Wall Street and in academia, who can't get it through their thick skulls that the Chinese, as a nation, since the state-owned enterprises still have an enormous impact on their economy, as a nation, they are not playing for profit; they are playing for employment.
Mm-hmm. That's such a great point. I mean,
you wish that people start with that, and everything else kind of falls from there.
Well, you wish that we started with the basics everywhere, Dan. When we talk about, you did a great job, in particular at the beginning of this conversation, laying the foundation of the triad that is really Germany, Japan, and China. And I really, day to day, week to week, month to month, building this firm. I go to institutional investor A, B, C, D, E, and it's just so loose. The foundational kind of, there's a macro tourism to it, some people call it, but
it's a very good expression.
The foundation really isn't there, and I guess what you have with Trump is just a constant agitation of something that doesn't have a foundation to begin with in terms of a fundamental understanding. So. That's another maybe the last question, because I know you're busy and need to go. But the agitation. So if there's no fundamental understanding or a consensus on basic stuff, supply, demand, Chinese wanting employment over profits, some pretty basic stuff that we agree on. And you sit there and say, okay, there's no foundation, and I have an agitator. Therefore, there should be massive amounts of market volatility. But in sharp contrast to that expectation, for the year to date, the VIX is down 22%. Since Trump's been elected, the VIX is down 50%. Does it surprise you at all that what we're having is the antichrist of volatility, given the subject matter?
No, and this is true of all secondary markets globally. It took literally a 2x4 over the head to collapse the oil market. And the great example, I think I alluded to it before, is people saw futures rallying and demand pushing up oil to $110 a barrel. on the assumption that the emerging markets were buying so much of it that that demand was infinite and would grow to the moon. And what it really was the Chinese themselves and others buying oil futures because they feared deployment in the dollar, which they thought mistakenly was going to deflate, depreciate. As soon as they realized they were on the wrong side of that trade, they dumped. And then we started to see the real effect on oil of the additional supply, from fracking and what have you in the United States, plus the additional supply that was coming on from Libya and Iraq and all these other places, and now Iran. So you literally had to whack that market over the head with a 2x4 to get it back into alignment with reality, with the underlying macro realities. Why does that happen? The reason that happens, and the reason that's become sort of a trademark of this era, is when you have a global capital glut, right? Capital starts to back up and say, geez, I can't make a dime taking risk-free returns anywhere.
Yeah.
And for a while you had negative returns in the most, with the exception of the United States, in much of the short-term part of the sovereign market abroad. And so people were sitting around going, geez, I can't make any money. What you want in any sort of a capital misdeployment, which I would argue a glut is you want that capital to find its way into the formation of primary investment, right? You want that excess savings to move into primary investment. You want it to create in the government sector bridges and tunnels and airports and what have you, and in the private sector plants that employ people and equipment that manufacture stuff. So that's what you want to happen, and that's where this whole notion of savings and investment and the whole concept of classical capitalism comes from. But the problem is that when that stops, because there's arguably we're in the age of oversupply, title of my book. You don't need additional primary investment, and so what happens is that capital becomes hyper activated in the secondary markets. And so when you have a thing like the election of Donald Trump, right? I was sitting there saying when the numbers started to turn late that night on election day, I said, this is going to set off this huge rally in the stock market. Everybody was like, what, are you crazy? Of course, nobody had written about it because nobody thought it was a possibility, right? So 24 hours in, boom, market turns around and it shoots up. Why? Because you create a catalyst. You create the bond market was cooperative to a certain extent, and that the bond market sold off, so people saw the bond market selling off, and they flew into equities. But right now the big question is always don't look at the VIX, don't look at the level of the market. Try to answer the question: where's the capital going to go? Right. All you need, of course, is catalyst in the opposite direction, and that capital will flee back to the Treasury market. But it's not surprising when you're in a condition of capital glut and low yields and low returns in general.
Because your basic premise here is that by virtue of oversupply, it's a zero-sum game. The capital just chases the most recent move in the capital.
Yeah, I mean, and look, there is a way, sort of the what I've been saying for the last years, 2-3 years, is that the virtuous cycle of capital is broken. It has broken down at the level that gives rise to these gluts. It's broken down because you have Germany taking advantage of a low euro and massing up a huge surplus. It's broken down because you've got China and Japan, the whole other thing. So those are the big systemic issues globally in terms of trade. But it's also broken down because at the same time we've suffered that, we have suffered this sort of after effect of the Reagan era, fiscal conservatism, and that is people have not broken with that adequately, and hopefully over the coming years we will. That we can restore that virtuous cycle of capital simply by having government step in and saying, okay, you want to lend me money at 2% for 10 years? I'll take it. I can do better than 2%. In terms of a rate of return, right? extracting it. I mean, think of what would happen if we instituted that kind of a program. You're telling me we couldn't make more than 2% a year in terms of additional taxation from all the steel we'd be creating and all the jobs that we'd creating and everything else? It's not a difficult bit of math to prove.
Well, with time, things change. I guess, actually, I think today would have been Reagan's 106th birthday.
Happy birthday, Ronnie.
I think today is
he would have been declared a rabid liberal. How do you like that?
But with time and space, as you know, there is education. So thank you very much for providing not only me, but a lot of people a different perspective on what's actually happened here. I think it's a great education for all of us.
My pleasure.
All right, we'll talk to you soon. Thanks.
All right, take care, Keith. Bye.
I'm Keith McCullough, and he's Daniel Alpert. You can find him at Daniel Alpert. That's his Twitter handle. He's the managing partner of Westwood Capital, and that was indeed a real conversation.